Before we get into this episode, I just wanted to say, for anyone who is thinking, oh my good God, what is happening in the markets right now? How do I invest in a way that's not, scary? If we're being totally honest, everything happening in America right now is reasonably terrifying. And what we're seeing in the markets is that they are having a really rough time. So we're hosting a free workshop on Tuesday, this coming Tuesday, for anyone that would like to come and just feel a little bit more confident when it comes to why and how you can invest in the current environment. And in this particular conversation that we have with Zoe Wallis, who is an investing expert from Tempo, which is a guided investing app, she speaks so much about how we can invest in a really diversified, clever way, given what's happening in America right now. And there's some really great takeaways from her about the things that we can be doing to kind of mitigate risk and invest in a way that's actually going to hopefully grow our portfolios. Wow. So we hope that you enjoy it. There's going to be 3 of these episodes. So 1 this week and then 1 next week and the week after. And each conversation with Zoe is going to be focusing on a key theme, like something that's happening in the market that is interesting and worth looking at. And so this week, we are looking at Trump and what's happening in America, which you might be sick of hearing about, but if you're investing or you want to grow your money through investing, it's a really important conversation to be on top of. So we hope you enjoy, and here is the episode. Okay, Vic, you're being outsmarted today. We have got another investing expert on the podcast.
Zoe, welcome.
Thank you. Exciting to be here.
We are doing an amazing partnership at the moment with Tempo, which is guided investing. So when you join Tempo, you answer a whole lot of questions about like who you are and what your goals are. And then they're able to recommend particular funds that will suit what you're trying to achieve. Behind the amazing front end that you see is investing experts like Zoe, who are helping make these investment decisions and recommendations. And so we thought it would be cool to get the brains on the podcast. Not the only brains, we must say. There is a whole team of experts. But to be able to pull someone out and just be like, can we just chat to you and ask a few questions is very exciting. So thank you so much for joining us on the podcast.
You're very welcome. I feel like that's quite a lot of pressure after an intro.
Is it? Oh, sorry. That wasn't the intention. No. I just think when it comes to investing products or services or the financial space, there isn't a huge amount of understanding from the everyday person of what those things mean. And I think when someone hears guided investing, they're like, amazing, because it means I'm not having to make all the decisions myself, dream, but you also have visibility on what you're doing. I think that makes sense. But then the question of, well, who's the face behind this or who is the expert? Like, it's nice to put a face to a name. So I think that to be able to kind of hear your expert and your insights on investing will make people probably feel a lot more comfortable and excited about the idea of trying Tempo. So that's kind of the purpose. I think as someone who was your average punter, let's just say.
Average punter?
Your average punter. That sounds like I'm going skiing.
It sounds like you're gambling.
Yeah.
Oh my God.
Average punter is like you're punting the market? No, you're punting
on a horse?
No, punting. No, you're all just thinking money. Punting and the everyday person that's not an investing expert. Yeah, like you're a punter. Like I'm a punter. I like pizza all the way down the hill. You're a punter means you're a beginner.
No.
Does it not?
Right. We will Google
Punting a boat?
A person who places a bet.
Right. Well, that's not what we're doing.
We're not encouraging gambling at all.
So, Zoe, you've worked in investing for a long time. Can you just give us a really quick overview of your career, what you studied, the sorts of jobs that you've had, and how you've landed as, me describing you as an investing expert? Like, how did you get there?
Sure. So I studied economics and finance, a very boring standard degree for the industry, I would say. Probably, yeah, there we go. But I did actually start doing a bit of side on psychology, and maybe we can come back to that because it's actually quite interesting. I think there is a huge amount of psychology when it comes to investing.
I wish I'd done psychology.
Yeah, I kind of wish I could
say it
as well.
actually, but not necessarily for money, just because I think it's so interesting.
Yeah. And then I started my career at the Reserve Bank, so very standard economics path, but more in the financial market space. So I actually never worked in the economics economics team, but very much financial markets focused. So looking at what was going on with the currency, what was going on with global equity markets and how that might impact New Zealand.
Cool.
I then went over to London for a couple of years, did the OE thing, decided to come back for a little bit and then ended up staying back. But was then...
Did I sense that you met someone, you fell in love and you stayed? Like, I feel like you really skimmed over that. I'm assuming that's what that meant.
Well, yeah, I came back for a year because I got a great job offer to come back to the Reserve Bank and be a portfolio manager. And so came back to do that for a bit and see how that went. And then I met my husband and...
The rest is history.
Yeah.
So a lot of your job, tell me if this is wrong, but this is my interpretation, is you are very aware of what's happening around the world. You do a lot of research that inform investing decisions. So you look at trends, you look at what economies are doing, you look at stock markets. You really have like quite a full picture of what's happening when it comes to money, business, the world. That's the sort of information or lens that you make investing decisions and recommend others to make particular investing decisions based on what you think from that research. Is that like the most simplified way of saying it?
I think like my sort of particular way I come at it is from a very much top-down point of view. So you think about big picture, what's going on in the global economy, what's going on with Trump, what's happening with New Zealand, and interest rate cuts going to start helping people in their everyday lives and help reduce living costs or help people make their mortgage payments better. All of those sort of pieces and how that impacts what happens with investments, obviously. So what happens with fixed income investments and bonds, or what happens with global equity markets.
I'm just going to pull out from this and say, does that then mean, let's just say interest rates are skyrocketing, that then means some investments do well and some don't. So your awareness of that means that you can help people balance their portfolios and where they put money based on where they're going to get better returns.
Yeah, exactly. So, for example, take that sort of interest rate example, when interest rates skyrocketed following COVID, for example, the New Zealand local equity market in aggregate tends to be quite interest rate sensitive. And so when interest rates are higher,
You're so smart. And you're like, you really have to...
I could just see, there's another big word in there.
Sorry. Yeah.
No. She just means that the New Zealand stock market tends to do worse when interest rates are rising. So the decision would be like, let's not invest money in New Zealand. Let's invest money elsewhere into countries or sectors that do well when interest rates are rising. Like banks, for example, do well and tend to do well, depending on what's driving the interest rate rise, but tend to do well in a rising interest rate environment. So that's what you mean by top down.
Yeah.
And then you'd look at the banks and you'd go, okay, which one of the banks? You're filtering it down going, okay, interest rates are increasing.
Yeah.
So it's doing that top-down approach that you were talking about in terms of, okay, which country will do well if this happens in the world? Okay, which sectors within that country? Okay, what companies within that sector? So you're like filtering down and creating a portfolio that's going to do well from a top-down view, or creating a fund that's going to do well.
Yeah. And to add to that, it's probably not, interest rates are going up in New Zealand, we're going to pull all our money out of New Zealand and we're going to put it in Australian banks. And it's more just at the moment we think there's a relatively advantageous macro environment, like top-down, big picture economy environment in Australia versus New Zealand, for example, or the US versus New Zealand. And therefore we tilt a little bit more money that way.
So it'd be like, okay, cool, we've got 50% in Australia right now and 50% in New Zealand, but we can see there's like a mass exodus from New Zealand to Australia at the moment, particularly with young people, in terms of immigration. So it's like, oh, actually, the Australian economy is doing better. Let's put 70% of the money into Australia and only 30% in New Zealand until that comes back into favour, essentially. And then you might switch that back to more 50-50. So it's not these big swings like you said of like, oh, Australia's doing well, let's pull all our money out of New Zealand, put it in Australia. It's like, let's just increase the percentage allocation a little bit so that we can get a better return because Australia's going to do well. That's what we think.
Yeah. We got quite technical quite quickly.
Yeah. So let's just say watermelons are not in season. If someone's continuing to try and buy watermelons and they're really expensive and they're not in season, it probably would make sense if they bought different types of fruit for that period of time.
Yeah.
Yep.
Sort of.
It's like the idea that it might not make sense to have your money, spending money on this right now because it's more expensive or it's not.
Yeah, it's more, if you saw a whole lot of people not buying a certain product, you wouldn't keep investing in that product. You'd be like, actually, this competitor looks like it's actually doing better. It might do better for another couple of years. Let's put more money, invest in that company that seems to be doing better. And then when the other one sorts itself out and maybe starts getting a bit more competitive again, we'll put money back into that company because that's going to do better. So you're not timing the market, but you're trying to make the most of
these cycle conditions almost. It's like if you were a watermelon farmer, you want to plant your seeds where you think the weather conditions are the best, where the climate's going to be favourable, where you're going to have an easy customer base, all of the things that, kind of would help your business. Yeah. So you want your climate to be favourable to start, and then you've got to get your fundamentals right as a watermelon farmer.
I'm just thinking if I ejected myself from this conversation, you two would be on fire, like if there wasn't someone being like, hold on, excuse me, wait, let's play that again. Tempo is a brand new investing app available in New Zealand, and we're so excited to be telling you about how it works and how you can use it. So in 2023, Tempo conducted a survey with 1,000 Kiwis, and they found that 27% didn't know where to start when it comes to investing. And that's a lot of people. So the great thing about Tempo is that their goal is to take the guesswork out of investing. So when you sign up, they ask questions like, how do you feel about the idea of your investments going up and down? Because some do more than others. You tell them how much you want to save, and they recommend a mix of their funds for you. It's guided investing. So you're getting investment advice from the experts, which is very, very cool. And because they track your goal progress so they can see actually how you're going, they can also recommend that you change your investments and the mix of how you've invested over time, which is really great. So if you would like to try Tempo, you can get a $10 kickstart into your account. And if you would like to learn more about Tempo, you can head to the link in the podcast show notes. Okay. Could we maybe use an example for people who are listening and thinking, okay, I kind of get it, but like how do Tempo or how does Zoe make a recommendation about investments based on what's happening in the world? So let's look at what is happening in America, because Trump, and like we've spoken about it a lot, particularly in the Curve Weekly in this podcast, just about the way in which what we're seeing and like totally just predicting and chatting between the two of us as to like what we think is going to happen. So could we use that as an example, as a trend or something that's happening, and then how you might advise or give direction for people when it comes to where their money's going based on what we're seeing?
I think this is a really good one because it's like very high level. When I look at everything that's going on with Trump in America, if I was looking at a way to invest in what's going on, at the very high level, I'd be like, do I think over the next 4 years when he's in power that America's going to do better or worse? That would kind of be my standard thinking. And then it's like, if it's going to be better, then I want to invest in America. If it's going to be worse, then I'll be investing elsewhere.
Oh, that's like, quite interesting.
That's like as simple as you think. And then there's all these other things in within that of like different sectors, different companies. Like obviously the tariffs and inflation, everything's going to be impacting, there's going to be nuances beneath that. But like that's kind of my high level thinking. And there'll be reverberations around the world because a lot of US companies are global, all that. But to try and come back to how we were explaining before of like a top down, it's like, do you think something's going to be better or worse? Therefore, you invest more or less.
The other element I'd add is that, we went and looked back through political cycles and, does it matter if it's a Republican or a Democrat? Actually, the answer over history is not really. Yeah. So right-leaning policies, left-leaning policies, actually what probably is a bigger driver of what happens with financial markets, with equities, with stock prices, is where you're at in your economic cycle. And by that, I mean, actually the US economy is really solid at the moment. They've got an unemployment rate of 4%. That's really low. Consumers are still looking really healthy and spending lots of money. All of those things are a big tailwind. And so that macroeconomic environment's helpful. So that gives you a good starting point. But then you've got Trump probably adding quite a bit of volatility based on what we've seen in terms of market reactions.
Movement up and down.
Yeah, exactly. So just sort of, people trading on headlines and sort of shock and awe announcements on X that had come out. And
well, like we saw that not that long ago, and he was like, we're going to put on tariffs. Yeah. Oh, no, we're not. Oh, yes, we are. It's like, oh, my goodness. It's, like he He's not your typical
Generate
politician.
headlines.
He's shoot from the hip, see how this reacts. Oh, this wasn't what I expected. Okay, we'll reverse that. Whereas
I reckon he's probably having fun doing it.
Oh,
as
I
well.
agree.
He's probably looking at the markets thinking, ha, suckers, they pulled their money out thinking that was going to happen, and then it goes off and they're like, knew I could, like,
He's
he
probably
would
the
have
trade on
such
it.
a big ego, wouldn't he?
he's probably trading up too.
True.
Yeah.
He's probably like, no, surely that's illegal.
Well, Trump coin. They're like,
Yeah.
hot Trump coin.
He's got his own cryptocurrency.
Crypto.
So he started his own crypto and then was like, US is going to be the crypto capital of the world. And then it just took off.
He made what, 60
Yeah.
million? It's some insane.
I mean, he's
amount of
pretty
money.
clever.
Yeah.
Got to give him credit for that. But there's, like,
And there's Melania coin as well.
There's what?
Melania.
Melania.
There's a Melania coin.
Yeah.
I feel like we're living in like the Sims game or something.
Yeah.
Like it feels too ridiculous to be real.
Money out of thin air. Kind
So
of.
then let's just zoom out for a sec, Zoe. Let's say, so this is all happening. You've got on one side, the idea that whoever's in power doesn't actually impact in isolation, the stock market, but then you layer on Trump and his like all over the show decision making. What is your view on what's happening or what's going to happen across the next 4 years?
Yeah, so look, if you take a step back as an investor, hopefully if you're investing in shares, for example, then your time horizon is a minimum of 5 to 7 years, right? So theoretically, you also want to be looking through a lot of this noise. So, if you invested in your portfolio today and there was some US, you had a nice diversified portfolio, you should almost close that down and not look at it for a year.
Go on holiday, go to the desert island.
Yeah. And a lot of that volatility, those ups and downs will kind of work themselves out over time. When you think about that long-term investing horizon, that's really what you want to focus on. So coming back to your fundamentals of making sure you're not just, all in US stocks, for example. You should have some other international shares and some New Zealand shares and Australian shares in your portfolio. So also just depending on how much risk you want to take. So how prepared you are to sort of experience some of those ups and downs might mean that you're not invested just in stocks, is that you might look at some other assets as well.
It's like what you said before about America being in a really strong position with unemployment being really low and all of that. It's like, yes, but you still want to be diversified because there's always things that we can't see around the corner. So you don't want to put 100% of your portfolio into America for the next 5-7 years. It's like you still...
Do you mean in case you need to pull your money out? And is that what you mean? Or are you just meaning in general?
I just mean in general, and you're just diversifying in general because it's like you never know what's going to happen. But I think diversify and long-term and taking that long-term 5-year plus horizon is the key things that you can do when we're in a volatile environment, which we're going to have for the next 4 years.
But I guess my question is like, I'm not planning on not investing for the long term. Like I'm still going to continue to invest in the stock market in the US. I'm going to invest in other places. I think that's a really important point. But like for people that are just curious to see like what's going to happen in the next 4 years, like I just want to know what your thoughts are because you've done a lot of research. I'm not going to be making investment decisions to try and like make a quick win in 6 months' time. But like I just would love to know what you think about what we're going to see because your investment knowledge and your research is so like focused on these types of things. I'm just keen to hear what you think.
Yeah, for sure. So when Trump came in, and there were sort of 4 key things he basically campaigned on. So one was tariffs, other was immigration. He's been really quick out of the sort of blocks on implementing those. So, he's very quickly come down on border control. So what you've seen in the US over the last couple of years is a huge inflow in migrants crossing the border into the US. And to be honest, that's been actually quite helpful for the US economy because similar to what happened to us post-COVID, we had a real shortage of workers, so did the US. And those immigrants helped meet some of that demand and alleviate some of those shortages of people to fill jobs. And there was really strong demand for those people. So he's cracked down on that. He's cracked down on, tariffs are kind of coming quite quickly now. But the other 2 key pieces he campaigned on, so one was deregulation, so just less red tape. That's something we've been talking about in New Zealand as well. So just freeing up companies to have a bit more autonomy, less hoops to jump through, perhaps from a legal perspective, tends to make business go faster and more efficiently.
Which I find quite counterintuitive considering he's implementing tariffs. Like the whole deregulation is just like, let's just let things flow and let
Free market.
Free market. Yeah, let's make things work and just like, no red tape, no hoops to jump through. Yet he's now slapping on tariffs to be like, we want everything that it can be to be produced in America. Yeah, it's like, but what if there's a country over there that can do it better and quicker and get
the whole point of free
And
trade.
then what was the fourth one?
The fourth one is taxes. So he's promised to extend personal tax cuts that are in place at the moment, which were due to roll off. He's also promised to cut the corporate tax rate down from 21% to 15%, which is quite a low corporate tax rate. That's almost as low as you can go, basically.
And so what do you think all of those things, how do you think they will impact what we'll see in the stock market and business success? And
Hard to say in aggregate, depends on the company is probably the cheats answer. But look, I think you've seen two of them which are quite punitive. So the two things he's done tend to be
punitive, man. Sorry.
pretty harsh in terms of the implication.
Yes, yep.
So the tariffs are likely to be inflationary. So what it means is that when a foreign company sends a good to the US, because US wants it, the company who's imported that has to pay a premium when it lands in the port in the US. It has to pay their tariff, be it 10% or 25%, whatever Trump ends up deciding. That cost, at that point, the business has a choice, right? Do I wear that cost myself and just take it out of my profits? Or do I pass it on to the end consumer? And if you're running a business and you've suddenly seen your cost of goods that you're going to sell go up 25%, what you're probably going to do, if you can possibly get away with it, is just pass it on to the end consumer. So for the average American, what it'll mean is that the cost of imports goes up. And there's lots of things that the US imports. So cars has been a key one in the spotlight. Things that come from Mexico, examples, avocado, tequila, beer,
All the fun stuff.
Yeah. Maple syrup from Canada.
Yeah.
And so the cost of those for the US consumer goes up, which isn't great when that's, you and me, if we were sitting in America, then the cost of our average shop would probably start going up. We'll feel a bit less well off. That's not a great feeling. So it pushes up what we call inflation, but it also means that you're going to have probably a little bit less disposable income. You might not be feeling quite so positive about how things are going in the economy, and it tends to dampen economic growth and how much activity there is.
So this was what we spoke about in the Curve Weekly about impacting corporate profits. So overall, it's estimated about 2 to 3% overall impact. And again, it's so sector specific and company specific, but I can never say that word.
it's so funny because as soon as you say that word, I can't concentrate on what to say.
So it does depend on which company and which sector, but overall, about 2 to 3% of an impact on corporate profits. So
then what do we think will happen? Because I understand that from a consumer standpoint, that makes total sense. But how does that then in turn come back to what we see from business success?
Well, so I guess the other question is whether or not Trump does manage to get his tax cuts through. Because if Trump can deliver those corporate tax cuts, that takes their effective tax rate from 21 to 15. And that's a big boost because that's more money that those businesses get to keep on their bottom line.
So they might have to charge more to customers, even though their cost has gone up. So they kind of, that net, that's...
But because their corporate taxes, it means they're actually okay.
Because their corporate taxes are down, they probably, net will have a increase in profit. I mean, it's
probably, depending on where they land.
So what I'm hearing here,
it depends.
Yeah. No. What I'm hearing
Fine,
is
T's and C's, all of that,
life will be more expensive for the average American. Probably pretty rude. That's quite likely. Secondly, there is a chance actually that businesses in the US particularly maybe aren't worse off. And also third part to that is, if really who's in power doesn't have an enormous impact on the stock market long term, there's a chance that the stock market's not going to take a giant nosedive like a lot of people are probably thinking or feeling or worrying about. Is that kind of like a fair enough summary?
Yeah. And if you hold the S&P 500 ETF or a diversified fund or portfolio, there's going to be some that do well out of this. There's going to be some that aren't. But that's almost your best bet rather than trying to pick the ones that do and pick the ones that don't. Because we know that Trump's just so shoots from the hip. So you might be like, yes, I've picked the ones that are going to do well in this environment. And then tomorrow you wake up and he's announced that, no one can come into America ever again.
You've already seen that as well.
Yeah.
Some of the kind of favourable Trump trades that were in fashion, even as recently as November.
Yeah.
Aren't the ones that necessarily are doing as well. And similar to what we saw during his first presidency was some, the initial kind of opportunities around winners didn't end up necessarily being the ones that actually did that well for broader economic reasons or broader cyclical reasons.
So then taking from that then from an investment standpoint, if there's people listening trying to figure out where they want to put their money, the best and safest option really is to be like as diversified as possible and to not be thinking about those quick wins. Like, oh, I think because Tesla and Elon Musk and Trump are in bed together and they're blah, blah, blah. It's like, yeah, you don't necessarily know what's going to happen. You're much better to be going broad. Is that kind of the overarching takeaway?
Yeah, trading on fiscal policy, and I'm saying trading, not investing here, you know, short term can be really dangerous, right? And particularly with someone as volatile as Trump. Because you might back your winners that look like winners week 1 don't look like winners week 4.
Okay, I feel like that's a really insightful, good take. In the next check-in that we do with you next week, can we focus on another trend? I'd love to go in depth on a trend, but then also answer some questions. So if you're listening to this and you're thinking, perfect, I don't want to actually ask Victoria my question, I want to ask Zoe, then send us a message, either comment on this podcast with anything that you want her to answer, send us a DM, whatever works for you. If you're in the investing club, you can comment in there, and we will collate those and come back. And we'll do another, I think a themed conversation's quite cool, and then we can take some listener questions.
Sounds great.
I'm like, watch out, Vic. She's talking. Thank you so much for joining us, Zoe.
Thank you.
Thank you so much for joining us for our tempo temperature checks. Really need to brainstorm creatively and not choose names for segments that are very difficult to pronounce, but these are essentially conversations to help you understand what's going on in the market and really hone in on a specific topic. So we hope that you've enjoyed it. Next week, we're coming back with another one. And until then, if you've got any questions or comments, please do write them below on this podcast episode, wherever you're listening to your podcasts.